80 degrees.
But you're hot
inside.
natured. You're hot natured, aren't you?
I am. My wife would probably be okay with it, but I would burn up.
Well, we'll have to douse you with water like the next couple of days or something to keep you cool.
Yeah.
We'll get you one of those frog togs.
Frog togs.
Yeah, one of those things that you can keep around your neck all day.
Have you seen the frog tog rain suits?
Yes.
That just look like you're wearing a massive tarp?
Yes. But does it do the trick?
Do you own some?
I do not. But does it do the trick?
I don't know. I've never worn them.
Got to.
Yeah, I mean, you're wearing tarp clothes.
Yeah, either that or waders. So, what are you going to do?
Tarp clothes.
Yeah.
Frog Tog. How are they doing? Did they IPO? Are they doing?
Frog Togs?
Yeah.
I don't know.
Do you own any Frog Tog stock?
Not that I'm aware of.
Not in any funds you're a part of?
No, but after the next 3 days, I may invest.
That's right.
So.
That's right. Well, cool. Hey, I want to get into what we're talking about today.
Okay. Not Frog Togs?
No.
Okay.
I mean, we kind of already talked about Frog Togs. We can keep talking about Frog Togs.
No,
what a name, by the way. Frog Togs.
Probably not an episode's worth, but that's all right. We can get into the money stuff here.
Yeah, let's get into the money stuff. And I want to jump straight in to a little bit about, I know that you had Cameron Clark on a couple weeks ago, and y'all were able to dive into what the commercial real estate market looks like locally.
Yeah.
Very grateful for Cameron coming on.
Yeah.
And how would you say that, not the interview went, but what was his outlook on the area? I guess is kind of.
Yeah, I mean, just to recap a little bit, obviously he's very bullish on the area. Vacancy rates are extremely low. I think he said they were climbing close to 2%, which is just absurdly low. So very bullish on the area. Felt really good about where commercial real estate is, specifically in Northwest Arkansas. We see it every day around here, right? Things are getting built. In our profession, obviously we've been a part of a lot of different projects that are very successful and things that are going on around here. So, like I said, very bullish on the market. Felt like, especially in the next 5 to 10 years, we're just going to continue to see a boom of growth. So that was awesome to hear from a guy who really, really is involved in it every day. And it was a lot of fun to talk to him.
Yeah, absolutely. One of the things about commercial debt that is different from most people have consumer debt, which would be your mortgage.
Well, yeah.
Your car.
Mortgage loan, car loan, buy an ATV or something like that. I don't know.
You have an ATV?
I don't have an ATV.
Throw your frog togs on and go for a spin.
That's right. No,
Rain or shine, I'm
right,
popping
man.
on my ATV.
That's right. Got to get to work somehow, right?
Yeah.
No. But yeah, those are Those are your main.
So those are your consumer loans. Yeah. Commercial loans are a little different in the way that they're structured.
Yeah.
Right. So we did have Jason Carter on. Jason Carter said that most home loans, if they're going on the secondary market, which everybody knows what the secondary market is. Thank you, Jason.
Yep.
If you don't know, go back and listen to our episode with Jason. But all of those loans are fixed for 30 years.
Right. So fixed being they are the same rate for 30 years unless you refinance.
Yeah, whatever you got in at, that's going to be your payment for the next 30 years. You can count on that.
Yep.
On the commercial side, how do those loans differ from a 30-year fixed loan? Yeah.
So Luke, you and I are both in, like you said, in the commercial lending world here. And so, there are a variety of structures with a lot of those loans being held in-house, right? So we've talked about some secondary market loans, being sold off and that kind of stuff. But an in-house loan means that a lot of times these loans are repricing quicker, and so you're not necessarily fixing an interest rate for a extremely long period of time. It can be anywhere between 6 months to 10 years. With an average sitting probably around a 3 to 5 year, fixed time, and those loans will balloon after that time. So
balloon,
yes, balloon.
Why is it called balloon?
Honestly, 100% don't know why.
And balloon is when that term that it's fixed for, it's done.
Yeah, the term for the fixed interest rate ends. So you've come to an agreement.
So I've got a 4-year,
yes,
or 3-year 4%.
Yeah,
it's going to come to maturity or balloon,
right,
after those 4 years,
right.
And then I come back to you, or you'll probably call me as my banker.
yeah.
You'll probably call me 30, 60 days in advance, maybe 90, and say, "Hey, you're about to balloon."
Yeah, you're about to balloon.
That might scare somebody if they
probably
don't know what that means.
Use those exact terms, but
it might be offensive.
Depending on who you're talking to.
yeah. You're about to balloon. Hey, I'm watching my weight. Come on.
Yeah, exactly. Hey, I'm on the Atkins diet. Relax.
Ozempic.
Because Ozempic. But yeah. So you have like we talked about a balloon term where a loan will mature at that time. So it will basically, it gives you an opportunity for the borrower and the bank to have another discussion about where the loan is at that time.
Yeah.
Both from a credit standpoint, making sure that everything looks good, from a repayment structure, as well as, what the interest rate environment looks like at that time. But these loans are not being paid out on that term. Okay. So it may balloon in a certain amount of time. So the interest rate is fixed for a certain amount of time, but the loan is actually paying on a longer term, anywhere from, 10 to 15, 20, 25, 30 years.
Okay. So it's almost like breaking it out into quarters, or thinking about it in a sports world.
Yeah.
Not technically quarters.
Yeah. Well, it's kind of,
first quarter, we're going to give you this for, it's not actually, like I said, 25% of the length of time that you got to pay it back. But we're not going to,
Yeah.
You get it.
Yeah. So you're kind of, you're allowing both the borrower and the bank to have, have some, have a point in time to where they either renegotiate or they look at the loan at that point. So again, you pay it out over a longer term, but you have a point in time, that maturity time, or when that loan balloons, to where you get to look at that note at that time, on both sides. And if it's a lower rate interest environment, very advantageous for the borrower, right?
Yeah.
You're probably going to lock in a better interest rate at a lower term. If it's at a higher interest rate environment, that can be more advantageous for the bank. And so it's an interesting concept. I don't know who came up with it, but it's an interesting concept. And, a lot of the stuff that is done in the commercial real estate realm that is oftentimes different than a consumer loan.
Yeah. Well, I think when you get into the commercial lending world, we're dealing with really high dollar loans here. We're not dealing with a 3-bed, 2-bath home that's going to, be a $250,000 loan. We could be dealing with $1 million loan to, I don't even know, hundreds of millions. I don't know.
Well,
maybe some real estate could be in that realm. So ultimately, the ballooning periods helps everybody just readjust to where the market's at.
Yeah.
And like you said, that could be very advantageous to the banker. After the first balloon, second balloon could be very advantageous to the borrower.
Right.
So it's kind of a way for us to all kind of fall back to what the market's doing.
Right.
What kind of falls under commercial real estate? Like, I know that we said that your home, your car is consumer, are not commercial real estate, but what are we looking at when we are looking or considering offering a commercial loan?
Yeah, so it's really, I think the best definition would be real estate used for commercial purpose. Okay, for something other than your individual, the individual purpose. Okay, so that can be a variety of things. You've got retail, you've got office space, you've got you have rental properties.
Yeah, that's a big one.
Yeah, that's a big one too.
Especially around here.
Land that can be held for commercial development. There's a lot of different
multifamily.
Multifamily. A lot of different uses for commercial. It's kind of paint a broad stroke over a lot of different things, but the the basic definition is real estate specific used for commercial purpose.
Yeah. Well, I know that we kind of got an idea of where Northwest Arkansas was from Cameron, but I kind of want to take a step back and look at where the nation was today. And one of the things that's not really discussed outside of this article, I feel like, is it's no secret that interest rates have gone up.
Right.
Makes it really hard to borrow.
Right.
Well, when we say it makes it hard to borrow, that not only means the person who's trying to go out and buy, let's say, a multifamily, a duplex to rent out, some land for you to purchase and build on later, but that also makes it harder on these commercial loans that come to or have a balloon period. Once that balloons up, as we were just discussing, that rate is going to adjust.
Yeah.
And so I kind of wanted to talk about today what the effects of high interest rates will be on the amount of commercial real estate that's going to be ballooning over the next 3 to 5 years.
Yeah.
Right now, this is an article from The Real Deal.
The Real Deal.
This is no fake article, no fake deals. This says commercial real estate debt problem could get worse through 2027. $1.5 trillion will be due in the next 3 years.
Yeah.
That's a lot of cash.
It is a lot of...
It's a lot of... Not cash.
That's
a lot of debt.
A lot of debt. A lot of debt coming due. A lot of debt ballooning, the term that we used earlier, or maturing at that time. So
yeah. So here's kind of the thought process is this is definitely written more to metropolitan areas.
Right.
This is written to or about areas where we don't have skyscrapers really. Kind of. How many stories do you have to be a skyscraper?
It has to scrape the sky.
Well, where does the sky start, I guess? I mean, man, that got deep fast.
Got to scrape the sky.
How tall is the sky?
I don't know. I feel like if a cloud can...
So clouds are in the sky?
Clouds are in the sky, right?
I think.
Yeah. Okay.
I don't know.
If the top of your building can not be seen through the clouds at any point,
it's not a skyscraper.
It is a skyscraper.
If the top of your building cannot be seen through the clouds?
Yeah. So like clouds are at the level or a little bit lower than the top of your building.
Okay. So it could be seen above clouds.
I don't know.
It could be seen above clouds?
Yeah. So if you're flying, well, yeah. Yeah.
I don't know.
That's the inverse of what I said.
Yeah. I'm just agreeing with you.
Okay.
Stop yelling at me. So we don't have skyscrapers.
Okay. Yeah, we don't. There's none here.
Definitely not.
Yeah, no.
But when we talk about, let's talk about New York, Austin, Texas. I'm just naming big cities here. LA.
How did you go from New York to Austin?
That's got to be top 10.
I mean, I don't think it's a top 10.
Maybe not.
No. I mean, like
maybe
New
not.
York,
well,
Chicago.
It's on the way.
LA, San Francisco.
It's on the way. Yeah, those are great ones.
Yeah.
When you think about, I've never been to Miami.
Honestly, it is a really cool place. Very expensive.
Really?
Yes.
DJ Khaled lives down there.
Does he?
Yeah.
Well, maybe next time I can have him pay for my meal.
He's actually picked up golf. Have you seen any?
Yes.
It is so funny because he's such a motivational person.
Yeah.
He'll hype himself up like, yes,
I know.
right down the middle.
Hey. And then he hits another one.
That's right. Yes, he does. Never lost.
No.
That's LeVar Ball. Sorry.
Never lost.
All this to say, these large commercial buildings, okay, typically housing offices, okay, are coming to maturity in the next couple of, not even just these large commercial buildings, but all commercial real estate that was booked in the period of 2020, 2021, when rates were extremely low.
Yeah.
It is inevitable that these are going to balloon. Okay. That's kind of what we're trying to get you guys to think about is everybody heard about the sweet deals and on your house, you were like, yeah, I got this sweet deal. It's going to stay that way.
Yeah.
My rate's going to stay the same for 30 years. Well, your office building that you're in might not.
Yeah.
So one of the things that's kind of worrisome about that is work from home.
Yeah.
Work from home.
Yeah.
Which means for the people who actually have the debt on that building, you got to have tenants in there to be able to make your payments. What's so funny about that?
Well, you're right. I mean, they've got to pay you, the owner, the landlord, to who then pays bank.
Can you imagine like running, being the property manager of like the Chrysler Building or something?
Yeah,
the Empire State Building.
Yeah, I mean,
do you think that thing's debt free? No.
I don't think so. I think it's probably changed hands quite a few times too.
Maybe King Kong had it for a while.
Yeah, literally with his fist.
Yeah, he was a skyscraper at that point.
Yeah,
he was scraping the sky, right?
Yeah,
batting planes
down.
Yeah.
Did you know? Okay, here's an interesting.
He was
fact.
just misunderstood, by the way.
Here's an interesting fact about the Empire State Building. All right. It has a docking station. The antenna on the top has a docking station for hot, I don't know if it's hot air balloons, but the balloons, like the Goodyear blimps. It has a docking station for blimps. So when the Empire State Building
just sit on top of it?
was built, that was like the future of air travel was blimps.
Gosh.
And so
that whiffed.
Their forethought, was to establish a docking station. So you would basically hook the blimp up, walk down on the top of the Empire State Building, and be in the center of Manhattan in less than like 7 minutes.
All while having to dodge a giant gorilla.
I know. They take into account King Kong, but it didn't work. Obviously, for obvious reasons.
Yeah, I haven't seen that footage.
But I think winds can be upward of 50 to 75 miles an hour, so they had a hard time docking. But there was one blimp that docked.
There you go.
And I think the guy basically got off and then got back on. And
it was like, this was a terrible idea. This was a terrible idea.
Yeah. I wouldn't want to be up there on like a mildly windy day, let alone, an actually windy day. But
yeah. Okay.
There's food for thought.
So there you go. Tenants.
Or gorillas. Go ahead.
Gorillas, yeah. Tenants.
Yes.
Problem number one. Now, I know that a lot of people are starting to go back to the office, at least around here. So I don't know how much of a problem that is, but it's definitely more people outside of, working from outside of an office than ever before.
What is the justification of paying for office space if most of your employees work from home?
If they can,
Yeah. So, I mean, I get it.
Why would you?
Yeah. But there are lease periods that a lot of folks are locked into. And so I think that's why you're starting to see some folks come back. Companies are saying, hey, you know what? I'm paying for this. I'd like for you guys to be here since we're paying for it. But
yeah.
Okay,
so that's problem A.
Sure.
Or I guess problem A is rising interest rates and commercial debt is going to balloon inevitably.
Well, cost of capital was so cheap through COVID too.
Yeah.
That people and values were pretty high since people were buying and selling quite a bit, and so comps were up, and so values were high for commercial real estate as well. So you could borrow more. You could increase your debt. It was a lot cheaper to borrow too.
Right.
And so,
but now. Also, prices of real estate were a lot lower.
They were at that point, comparative to today, for sure.
Yeah. So that's actually, what did we say? A, interest rates. B, tenants. C, some values, like I said, not really around here, but across the country and especially in the metropolitan areas.
Yeah.
Have gone down.
Yeah.
Maybe not as much as they were originally appraised.
Yeah.
But that's a huge part of the lending process is the value of the asset. So let's say that you had a building in 2020 that appraised for $100 million. You want to use $100 million or $10 million?
Sure. Why just go big?
$100 million. Well, your loan amount's going to be $80 million. Your equity into it would be $20 million cash. What happens if the value of that building, let's say it was a 3-year balloon and you're maturing tomorrow? You're ballooning tomorrow.
Yeah.
What's the problem if you get a new appraisal to kind of get the value of your asset?
Yeah.
Let's just say this is the Empire State Building.
Sure.
Do you think it's over that $100 million? Oh, yeah. Right? You think that's pretty accurate?
Valuing the Empire State Building?
Yeah.
I would probably say it's quite a bit over that, yeah.
Quite a bit?
Yeah. I mean, how much is Dallas Cowboy Stadium was like?
Oh, I don't know. Oh, billions, right?
I don't know if it's I don't know if it's a billion or not.
I don't know.
It was up there,
numbers.
and the Empire State Building is probably worth a little bit more than that.
Yeah. Well, it comes with a giant gorilla, so
we got to get off the gorilla.
We do. But anyways, the appraisal.
Yes.
The appraisal. What happens if the value of that building is $95 million when you come back?
Yeah.
And look at it again.
Well,
this could happen on a much smaller scale, like your house or things like that. But
yeah, I mean, the problem right now, I think what you're talking about is that values have not kept up with cost.
Right.
And so something may be worth it from a third party appraised standpoint, or from a comparable standpoint, it may not be worth what somebody's paying for it. And so the equity required in, whether you're going to borrow funds from a bank or you're going to take out a loan on the capital markets, you have to have a certain amount of equity, into that project, or a certain amount of cash into it. So, your cash, if something is valued less than what you're paying for it, your cash is going to increase that you have to put into it, right?
Right.
So your initial upfront cost of capital is going to be a little bit higher. So what you're talking about from the ballooning standpoint, if the value has gone down, you've been making, a lot of times people have been paying the principal down, and so you're probably at a point to where in 3 to 5 years, you may still have that buffer that, we talked about an 80-20 split there. So you may still have a 20% buffer there, because you may be paid down, a couple million at that point. But if not, then you're in a situation to where, there may be an ask from a bank, or there may be an ask from whoever you borrowed funds from, to maintain that sort of that threshold, that 80-20 threshold, or some other threshold that they've established, and ask you to, put more cash in, at that point. And so that could be a conversation, but ultimately, what happens at that point is it's just not worth what you bought it for,
right?
Which nobody wants to hear that, right? That's not. You don't buy an asset hoping that it's worth less tomorrow than it is today.
Right.
You buy an asset hoping that it's appreciable, and 2, 3, 5, 7, 10 years, it's worth more. And you make money on the appreciation that you get there. So.
Yeah. And that's very frequently the case. Very, very, very frequently the case.
Well, real estate has, I think, over time been a pretty safe play.
Yeah.
For folks. Obviously depends on the market, right? But it's been a pretty safe play. It feels like a lot of times, even in Northwest Arkansas, we see something priced at a certain dollar figure, and we go, "Oh man, nobody's going to buy that. That's way too high." It sells. You look 2 years, 3 years down the road, and it is worth considerably more than it was.
Yeah.
Than the point in time where you thought nobody's going to buy that. That just feels like it's way out of the market. I don't think that's happening quite as much anymore. And I know really what we're talking about is things inversely going the other way, more in these higher metropolitan areas, but it's just been real estate over time, I think, has been a pretty safe play, especially for those who have the ability and the cash up front to kind of buy, make the payments, and hold real estate for a while. But yeah, I mean, there's definitely a lot going on with all of this debt repricing. And that's what's kind of crazy about it. It's such a significant amount of debt repricing at a time when interest rates have over doubled.
Right.
And so, it's something that, banks are thinking about a lot. It's something I know that the Federal Reserve is thinking about a lot.
Yeah.
It requires banks to allocate a certain amount of capital to make sure that, that they're safety and soundness checks are good, and and so there's just a lot going on, and plus, when it gets down to it, you want to make sure that borrower can make the payment.
Yeah,
and if their payment has almost essentially doubled because of interest rates.
Yeah,
that's tough. It's tough in both situations, and so it's something to pay attention to. Something that I think in some of these larger metro areas, something to really pay attention to.
Yeah.
Things around here don't have as many. You've got the Chrysler Building, or you've got a building in downtown San Francisco that may have over 100 tenants.
Yeah.
Right. You'd be hard pressed to find that around here. So there's something to say about some of those larger buildings, but it'll be really interesting to see what happens.
The craziest part about it all is that the high interest rates are all a game to combat inflation.
Right.
Like the fact that interest rates go up, the owner of the real estate has to pay more, so they bump rents up for whoever is the tenant in that building.
Yeah.
The tenant has to pay more rent, so then they might have some layoffs. They might not have those bonuses that year.
Yeah.
And all in an effort to make eggs cheaper.
Yeah. To limit the money supply.
Yeah. That's just one example.
Goal. Yeah.
But I've never really seen that. I've never really put that together.
Yeah.
But it's just fascinating the way that that supply can be controlled in that manner.
Yeah.
So
yeah. And it will be something to keep an eye on, especially over the next few years. We're sitting at a point to where the Fed has not increased interest rates here at the most recent in the most recent month, and so maybe we're at a point to where they're kind of flatten off a little bit. I don't know, but maybe they're at a point where they flatten off, and we see things kind of maybe normalize a little bit more. It feels like they haven't normalized. And so I think that's why you get some of these articles like this that go, hey, there's a lot of debt repricing. And if rates continue to go up, this could be really interesting.
Yeah.
This could be something to pay attention to.